Hello and welcome to the new trading week. This time traders will evaluate the long-awaited data on inflation in the US that is likely to show a slowdown. Ahead of the US Consumer Price Index that is due to be out tomorrow, traders began to price in this scenario already last Friday. US stock indices closed this weekly session sharply higher for the first time after a streak of 3 losing weeks. In the meantime, the US dollar slightly depreciated, although still staying near 20-year highs. Investors reacted to Jerome Powell's comments at the Cato Institute. The Fed chair emphasized that the central bank was determined to lower inflation at all costs and that he did not see the need to ease monetary policy. Markets took this as a hint of a 75 basis point rate hike at the September meeting. However, these expectations have already been priced in. Last week, traders were evaluating the decision of the European Central Bank to raise the rate by 75 basis points to 1.25%. This step allowed the euro to rise above the parity level against the US dollar. Of the previous weekly session, the euro recovered by 1.77% due to a weakening greenback. Unexpectedly for all, Christine Lagarde, the president of the ECB, who is known for her cautious approach, said that the rate was yet too far from the level that was necessary to tackle inflation. For your reference, the current pace of consumer price increase is the highest in the history of the Eurozone. Inflation is running at its record levels in the UK as well, and there are currently no signs of improvement. Therefore, the pound dropped to its lowest level that was last seen in 1985. Yet, thanks to a stronger euro, the British currency managed to regain ground on Thursday. Given the overall information background in the UK, there are no factors contributing to buying the pound. Experts are worried about a deep energy crisis and assess the plan of the new Prime Minister to tame soaring energy costs. Yet economists doubt that this new plan is viable, as it's not clear where the funding will come from amid a widening trade deficit and the prospect of a recession. Moreover, the political situation in the UK may worsen after the death of the Queen Elizabeth II. The Australian dollar also moved to retreat from previous lows last week. The Aussie advanced by 0.61% above the level of 68 due to the overall weakness of the US dollar. The Reserve Bank of Australia is trying to keep pace with other central banks in terms of monetary tightening and raised the rate by 50 basis points. Yet the governor of the RBA mentioned that the pace of the rate hike may slow down given the worsening coronavirus situation in China, the largest consumer of Australia's crude. More lockdown restrictions in China, Australia's major trading partner, means gloomier prospects for Australia itself. The new lockdown restrictions in China weigh down on oil, which lost almost 2% of its value. China is the second largest oil consumer in the world. On the other hand, crude prices are supported by the OPEC Plus decision to cut output by 100,000 barrels per day. Besides, the intention of some Western countries to impose a price cap on Russian oil may lead to a shortage of crude supply on the global market. Meanwhile, there have been speculations that the deal between Iran and the European Union is about to be cancelled, which means that the embargo on Iranian oil will stay in place. Finally, gold managed to close the last week in positive territory. The precious metal gained 0.53% and stayed above the level of $1,700 per troy ounce. This time it was supported by the weak US dollar. Still, gold is trading within 3% near its lowest level in more than 2 years. The yellow metal has lost its status as a hedge against inflation and economic uncertainty in the face of rising interest rates by different central banks worldwide. This is what the last trading week turned out to be, and now new week and new important macroeconomic events are coming. Don't miss our daily news reports to be always in touch with the latest events. See you soon.